Good morning. This is John Richardson speaking with you from Toronto, Canada. Today is Wednesday, August the 7th, 2024, and today I am continuing my discussion with Tim Symth in Boston, who actually has Canadian connections, and you'll see why that's important in a few minutes. How are you today, Tim?
I'm doing well.
What are we talking about today?
Well, I had originally, this issue of retirees abroad, as we call them, I've been calling them for a while, has kind of been one of the challenges of how to move to a residency-based taxation system. I think there are a lot of people who are in this position under the current system that maybe don't necessarily like the current system, but feel moving to a residency-based system would make them worse off. And in particular, there's a lot of fear, I think, of the Canadian model, which is, I think probably one of the most logical places the US could change its system to. It's, Canada's obviously directly to the north. There's a somewhat as similar as you can be in terms of a income tax system. A lot of the activism against citizenship-based taxation is coming from U.S. citizens living in Canada. So it is a very logical outcome. So I thought it'd be interesting to actually go through and try to figure out what are these concerns. Because I think people might be in this position, might be overthinking or being overly concerned of what the actual implications of a move to RBT.
All right. So that's a whole ton for an introduction. Let's back up a little bit, though. I think we probably need to get some agreement definitionally on what is a retiree abroad. Now, that is not somebody who happens to be retired and is living outside the United States, right? That's not.
No.
What does it mean by retiree abroad?
These are people who spend almost all of their work employment time employed in the U.S. tax system. They are now retired from any active employment. They're living outside the U.S., but they and I want to emphasize that because they're receiving all of their income is U.S. source income, and I would probably emphasize that most of it comes from tax preferred source income. So Social Security, pensions, 401k, IRAs, things of that sort.
So you're making 3 points here. Okay, to be clear. One, by retiree abroad, we mean somebody who they're retired from a working life, mostly in the United States.
Yes.
Two, their financial center of gravity has been in the United States, so whatever assets they have are U.S. source.
Yes.
And three, those tend to be overwhelmingly things like IRAs, 401k, Social Security, in other words, retirement type of income.
Yes.
Okay. So the U.S. has citizenship taxation. So presuming these people are U.S. citizens, they move to Portugal or somewhere, Mexico maybe. How would you describe their tax relationship to the United? And by the way, do these people typically have anything but U.S. source income?
I would say no.
Right.
It's almost 100% U.S. source income.
Yeah, so really, these are people who just sort of wake up one day and think, I'd rather live in Portugal or Mexico.
Yes.
And they get on the plane and they move there. Now, I think it might be interesting, okay, to talk about what their tax residency status is from two perspectives. Let's start with the U.S. Anything change?
No, because they're U.S. citizens and we have citizenship-based taxation. And so in practice, it doesn't change. They don't really, something like the foreign earned income exclusion probably doesn't really come into play because they're not earning employment income.
Well, they don't have foreign income, and B, it's
foreign. Yeah.
Right. So
yes.
basically, for these people, subject to maybe having to file an F-bar or something like that.
Yes.
Maybe a Form 8938 because of, bank accounts or probably
Yes.
just, right? I mean, they would have trouble opening a brokerage account outside the United States.
Yes.
Basically, their tax return looks exactly the same, doesn't it?
Yes.
Right. Except for what if they spend so much time overseas they become tax residents of, say, Portugal or some European country? What then?
Well, they have the issue then that they have the issue then that they would have to declare their worldwide income to the tax authorities in Portugal.
All right. They become tax residents.
Residents of Portugal. There's one thing I would emphasize: there is a way they can avoid that, and that is the treaty tiebreaker, which
Well, hold on
even
now. Okay. All right. All right.
which even with okay,
Okay, hold on. Well, let's not get too far ahead of ourselves. Okay.
okay,
Let's start off with so they become a tax resident of. I hate to use Portugal as an example. Let's
well, it isn't either. It's a country that has tax treaties with both Canada and the U.S.
okay. All right. Let's say Portugal then. And if they stay there long enough, they're going to be a tax resident of Portugal, right?
Yes,
Is Portugal also going to tax their U.S. source income?
yes, unless there's an exemption in the treaty with the U.S.
So actually, and then is Portugal going to give a tax? So this is U.S. source income. So the U.S. has first taxing rights, correct?
Yes, yes.
So would Portugal generally give a tax credit for against Portugal?
U.S. source, yes, it would. It would.
Okay. All right. So we have that. So that's sort of what probably is going on, right? But
Yes.
the point, it seems to me, is that there's really no difference, is there? They just moved to Portugal, they moved to Mexico, they file basically the same tax return. Maybe they pick up a tax filing obligation in the other country, but really, from a U.S. perspective, almost no difference at all, right?
Yes. I mean, to be fair, yes. And, you know, I don't know if we want to get into how it would work in a residency-based taxation. This is actually,
Let's not go there right now. Let's just concentrate on the issue. We can make that a third podcast, right?
yeah,
But let's just focus on understanding the situation of U.S. retirees abroad, because this is something that I think is important. Now, or maybe we do sort of segue into that or not, but I mean, are these people, they probably read the AARP, American Association of Retired Persons newsletter. Are they particularly
yeah.
concerned with citizenship taxation?
It's hard to know because we don't have a lot of good data. And if you're, do they favor the system?
Well, do they see it as, or are they damaged by it in the same way that long-term Americans are?
Well, you mean, I would say if they have a very high income, and they might actually do better under the flat withholding rates. So if they're paying taxes in the 37 or 39% bracket, and they would do better if their U.S. source income was withheld at 30 or 25%. But I suspect that is a small number of people. Those are the truly wealthy. So I would agree with you. They probably are not hurt that much under the current system, other than something like that.
They just don't have non-U.S. source income and
Income, correct. Yes.
right. The U.S. tax system is very punitive on non-U.S. source income and non-U.S. source assets.
Correct. Correct.
So, they don't feel any particular incentive to change the system. It's what they're used to, right?
Yes.
In the U.S., to be fair, when it comes to Social Security and things like that, it's fairly attractive tax rates and that. I mean, people can,
Yes.
get to a certain amount and not pay any tax at all, right?
Yes.
So why are they not interested in joining the movement for residency-based taxation?
Well, I think they're afraid that they have a better deal under the current system than they would, for example, if they were in the same situation with Canadian retirement income.
Okay, well, let me ask you this, right? If they were not U.S. citizens under the U.S. system, right? If they were not U.S. citizens, they were non-residents. Can you explain how they would be taxed on the Social Security income and the IRA income stuff versus how they're taxed as a U.S. citizen? What would the difference be?
With this one, it depends a lot on the type of income. With Social Security income, I believe there's a lower withholding rate. With pension income is probably the most generous. So pension income, they would actually have the option of either being taxed at the 30% withholding rate or being taxed at graduated rates on just that piece of income for pension income accrued after 1986. So a fairly complex system.
But generally, Tim, there's a good chance they'd be paying higher U.S. taxes. Is that correct?
Yes, unless they are a resident of a treaty country that has lower withholding rates.
Default is the Internal Revenue Code in certain circumstances imposes more punitive taxation on non-residents than residents or citizens, right?
Yes, unless you're getting into very high brackets.
Okay. So really, okay, all their income is U.S. source income. Okay. They're not being damaged by living outside the United States because they have no non-U.S. source income, etc.
No.
They're not really allies in, trying to create energy to move to residency-based taxation. Would that be right?
I think that's fair to say.
And for some of them, they're actually very nervous about moving to a new tax system because they worry about higher taxation on their existing income sources. Is that right?
Yes.
Okay, so I think that sort of summarizes the problem here, right? In terms of from
Yes.
purely U.S. perspective. So, when you look at groups like ACA, American Citizens Abroad, and that, is it really fair for them to, if this is what they do, it's not clear to me they do, but sometimes I think they do in some of these other groups, is it really fair to say that every U.S. citizen who lives outside the United States is sort of, in the same bucket?
No.
And you would agree that the primary difference, the dividing line really is, the source of the income and assets, right?
Yes.
That's the problem, right? So the retirees abroad, basically, the way we're defining them, because they don't have non-U.S. source income or assets, they're not being hurt by it, right?
No. They may not even have an F-ball requirement if they have less than 10,000 in a local bank account.
In fact, if they were well advised, they would want to keep it below 10,000, wouldn't they?
Yes. Yeah.
Absolutely. So, I mean,
And they're just using that to pay for, local expenses.
yeah. So, I mean, that's a great deal. And interestingly, although we're not talking about this primarily today, the digital nomads sort of leverage that in another way too, right?
Yes.
Right. Taking advantage of the foreign earned income exclusion. So this is an example. I mean, it's by no means, in fact, I think it's very clear that there is no unanimity among Americans abroad on the problem with citizenship taxation, right?
No, although I feel like retirees abroad, or whatever we want to call them, I think should be put off in kind of a separate. I think there's a genuine difference between people who are working abroad and earning foreign source income and people who are abroad and receiving only U.S. source income, passive income, and are no longer actively working. Yes. Vacation abroad.
Vacation abroad. Yeah. Okay. Yeah, I think that's probably a good way to visualize it, actually, because they don't have all the problems. So I mean that I think really explains why. And I suspect that when the debate on moving to residency-based taxation really picks up steam, I wouldn't be at all surprised if there's active opposition from groups like AARP. What do you think?
Yes, although I wish they looked at what other systems, what the actual implication is under a different system.
Okay, you want to help us with that?
Well, I think there's a lot of trepidation about the Canadian system. But in reality, I think the Canadian system for someone in this type of position actually works pretty similarly. So if you're, let's say, someone in Canada, you have worked in Canada for many decades, you probably have, you get a small amount of, you're probably getting some money from the old age supplement, CPP, which is Canada's version of Social Security. And you might have a defined benefit pension plan, which is tax advantaged under Canadian tax law. Then you probably also have an RRSP, DSP, what Canadians call registered accounts, which are very similar to 401ks and IRAs in the US. So the decision you have to make is, so I'd say this is the difference. So you can, and many people do, just physically move from Canada, and if they're in this position, they tell the CRA that they are still Canadian tax residents. And in that case, they might very well be filing a tax return from a foreign address, but they are still tax residents under Canadian law. And they, it isn't a whole lot different than if you're a US citizen. They are still declaring their worldwide income, which is almost all Canadian source income effectively. They may have a filing requirement if they have a foreign bank account. I forget what the form is in Canada, T1135. Yeah, but it's a higher threshold than the FBAR. It's like 50,000 Canadian. And you mean the run risk to this strategy? And I actually have read, there's a lot more videos on YouTube. There's a lot of advice to Canadians who wish to retire abroad from practitioners in Canada. And in fact, this is the common thing. If you're in this position, just stay a Canadian tax resident. The risk to this strategy is, of course, the CRA, because it's a residency in Canada is based on a facts and circumstances test. You can't just say, in theory, you can't just say I'm a resident or non-resident. If you do certain things that really look like you're never coming back to Canada, and the CRA thinks they'll make money off of you by the fact by taking this position, they can say you have made yourself a non-resident and you owe us exit tax, and you're not going to have to be withheld at 25%, which is the standard Canadian withholding rate. That is a theoretical possibility.
Yeah,
I can't find a lot of evidence of this actually ever happening.
Canada for 50 years as a resident.
Yes.
I mean, they just keep filing as a resident.
Yes.
I mean, that's right. And if the U.S. were to move, so I assume where you're going with this is that if the U.S. were going to move to residency-based taxation, these people would just say, no, I'm not a retiree. I'm a vacationer abroad. I'm just a vacationer. I still live.
Yeah.
That's exactly what you do, right?
Yes.
Yeah. I mean, so really, this, I think what you're saying, and I agree with you. I think this is a non-issue, right?
I think it is, and I'll add another point that even if you, let's say you're at some point you're near retirement, your situation at some point you actually do want to become a Canadian non-resident, but you are going to have a lot of Canadian source retirement income in the future. Let's say not right away. Let's say you're 50 and you're going to work 10 years abroad and you're going to retire after that. And you've been a Canadian tax resident for 30 years. In their system, there's a lot of, even becoming a non-resident, you are not, in my mind, you are getting a very good deal compared to the US. Yes, you will pay the departure tax, but all domestic and foreign retirement accounts or assets are exempt from the departure tax, which is not true of IRC 87780.
Oh, yeah. There's no question that 877A is far more punitive. There's no doubt about that.
Yeah. If you have real property in Canada, so you own land, houses, etc., as an investment, you don't have to pay departure tax on those because you'll be paying the capital gains when you actually sell them as a non-resident because it's situ Canadian property. So Canada still has the right to tax the capital gain when you sell it after you're a non-resident, so they aren't going to tax you on that. If you've only been a resident of Canada for a short time, like let's say you were just, this is more like someone who probably wasn't a Canadian citizen who just came for Canada to work for 3 years and was a tax resident, any assets you had prior to that, I think under 60 months, those are going to be exempt from the departure tax. And even if you get hit with the departure tax, first you can put up security
And I
to
have a suggestion.
essentially defer the gain.
Yeah, this is like, I think, a separate podcast. Why don't we do a separate podcast on how the Canada's departure tax works? Because I think it's important maybe to not lose sight of the main message here, right?
Yes.
That basically for certain Canadians,
Yes.
better to stay a tax resident of Canada.
It is. And that's what the advice is given.
And if the United States were to move to residency-based taxation, the retirees abroad simply become vacationers abroad. In other words, they don't sever tax residency with the United States. So this is really, I think not a real problem. But I think you got a good analysis here of, I think identifies why this is a problem and a pretty good discussion. Let's do a separate podcast on how the departure tax works.
Okay.
The U.S., perhaps comparing them. I think that would be useful. Maybe we can do that next week. But do you have any closing thoughts or advice for anybody here before we sign off for today?
Well, I think this is the advice you always give. I have not advised people as much to renounce, but I also, the more I've thought about this and the older I've got, I would start looking at seeing where you are with the 2 million level under 877A. And I think if you start to get up to, you have assets of 1.8, 1.9 million, I would start to very seriously look at your options and not wait till you're over 2 and could have a fairly significant tax hit.
Well, Tim, we're living in a very volatile world where
Yes.
I would agree that governments are becoming completely more interested in finding ways to confiscate your assets. Agree?
Yes.
So, I do think that's important. Great discussion. And again, I'm speaking with Tim Symth, who is a longtime, I think, student of the whole issue of global mobility, citizenship taxation. In fact, all these kinds of things, who currently in the Boston, Massachusetts area, known primarily for the Celtics having won the NBA championship this year.
They did.
Are you a Celtics fan?
I am definitely molded. So I did watch several of the games, the finals. I'm not someone who watches every game, but I watch a decent amount.
But you knew what was going on.
I did. But we win a lot of championships here. So at some point, the effect across all 4 major sports, at some point, the effect gets a little, I don't know how to put it. Yeah, it wears off.
More newsworthy if they're not winning.
Correct.
Yeah.
Yes.
We can see that Patriot situation the last.
Yes.
All right. Thanks very much. Till next time.
Indeed.